you are considering using the First Home Super Saver Scheme, you must have come across this page on the ATO. No one provides more comprehensive and up-to-date information about this initiative than the ATO itself. The only problem? Navigating through this complex maze of words and nested links can be overwhelming, and it's all too easy to stumble upon a misstep. In fact, some mistakes can render your efforts to use the First Home Super Saver Scheme entirely futile. That's precisely what we are addressing today, the 5 mistakes that make First Home Super Saver Scheme completely useless. Each point backed by the ATO's detailed guidelines here, which make it easy for you to refer back to certain sections of the Bible for more in-depth details and clarity. Plus, I'm going to share my best tips and tricks to help you steer clear of these pitfalls. Quick disclaimer, this video is purely educational, not financial advice. The examples and case studies presented are simplified for clarity. If your situation appears similar, I strongly recommend doing your own research or consulting a professional before taking any action. Now let's dive into the details. Mistake number 1. Not making the right type of contributions for First Home Super Saver Scheme. The key to maximizing the First Home Super Saver Scheme benefit lies in making the right type of contribution and making sure they are classified accurately by your super fund. Wait, but the ATO says the scheme allows you to make voluntary contributions both before tax concessional and after tax non-concessional into your super. This is correct, but if you are seeking the optimal tax benefits, one choice stands out. Let's break this down with an example using the FY24 tax rate. If you are watching this in a different financial year, the tax rate might be different, but the principle remains the same. By the way, if salary sacrifice is the only way you know how to make a before tax contribution, you might want to check out this video I made right here titled Why I Won't Use Salary Sacrifice for First Home Super Saver Scheme. In our upcoming example, we are using a much better method. Our friend John has a taxable income of $130,000 and decides to contribute $10,000 to his super for a home deposit in FY24. If he makes a $10,000 voluntary contribution as an after-tax non-concessional contribution, he won't be able to claim a tax deduction on this amount. The money going into his super won't be taxed as it has already been taxed in John's hands, so his super balance will increase by $10,000. When he eventually withdraws money from his super to pay for his first home, this $10,000 will be paid to him tax-free. Essentially, this is similar to saving the $10,000 in a bank account, with no additional tax perks. We are ignoring the deemed earning associated with this $10,000 that can also be released, as they are just slightly higher than the interest rate you would get from a high-interest savings account. To keep this example simple, we won't get into the details of that. However, if he makes a before-tax concessional contribution, it's slightly more complex but far more beneficial. Here is how. John can now claim this $10,000 as a tax deduction, therefore avoiding tax on it at his marginal tax rate of 37% plus a 2% Medicare levy. This move can reduce his personal income tax in FY24 by $3,900. Since this money is a before-tax contribution, a 15% super contribution tax is payable inside the super, and his super balance will increase by only $8,500 as a result. Yet, John is better off by $2,400. When he eventually takes money out of the super to pay for his first home, this contribution will be taxed at his marginal tax rate at the time of the release request, and he will receive a non-refundable tax offset of 30%. To summarize, the tax benefits of using the First Home Super Saver Scheme via before-tax contributions are: your tax benefit hinges on your marginal tax rate during those contribution years versus the release year. If they are equal, your benefit is 15% of the contribution amount. That's a pretty good return on your savings, isn't it? However, there is a crucial step many miss. After transferring funds to your super, they are initially classified as after-tax non-concessional contributions. You need to submit a notice of intent to claim tax deductions to your super fund. This can be done online or via a form provided by your super. Missing this step can significantly reduce the tax effectiveness of your first home super saver scheme strategy. Mistake number 2. Lacking a strategic contribution plan for the first home super saver scheme limit. Remember, funds in superannuation are typically locked until retirement, with one of the exceptions being the first home super saver scheme. Under the first home super saver scheme, you can request a release of up to 15,000 of your voluntary contributions from any single financial year, with a cumulative cap of 50,000 across all years. If you are at an early stage of saving for your first home, don't rush to max out your contributions right off the bat. Even if you already have the money, pace your contributions. For instance, if you don't plan to buy your first home within the next 10 years, and you already have 50,000 saved up for a deposit, it's more prudent to spread this amount over the 10 years rather than a sprinter approach of contributing 15,000 each in the first 3 years and 5,000 in the 4th year and be done with it. Contributing 5,000 annually over a span of 10 years can generally be more tax efficient overall. This strategy effectively reduces the top portion of your income each year, which is subject to your marginal tax rate. By spreading out your contributions, you are optimizing your tax benefits year by year. Additionally, life is unpredictable. You might need liquid cash, or your plans could change, like moving abroad and never buying a property in Australia. Funds contributed to super are generally inaccessible until your retirement or such time you're ready to buy your first home in Australia. It's important to balance locking your funds away and maintaining financial flexibility. Keep in mind, with property prices in Australian capital cities, a deposit is often more than 50,000. So you will need a saving strategy beyond just super. Depending solely on your first home super saver scheme for your entire home deposit might not cut it. Think of the first home super saver scheme as one piece of the puzzle. It's got its limit. You will also want to save up a parallel savings plan. This could be a high-interest savings account or a suitable investment, depending on how soon you plan to buy. It's all about having a well-rounded approach for saving for that deposit. Mistake number 3. Letting family members contribute to your super for the first home super saver scheme. It might seem like a good idea for them to contribute to your super directly for the scheme, right? But here's the catch. Any contributions to your super made by others will be locked until your retirement. That's because these contributions are not eligible for release under the first home super saver scheme. To put it simply, the first home super saver scheme only allows for the release of funds you have contributed yourself. The ATO's website clearly lists out what counts as ineligible contributions, and it's not just about who contributes. Even if you are recontributing funds withdrawn under the COVID-19 early release scheme, this won't be eligible for that first home super saver scheme release either. So if a family member wants to help out, a more straightforward way would be for them to offer you a direct gift. There is no gifting tax in Australia, so this approach is as easy as transferring money to your bank account. You can then use this gift to contribute to your super yourself. This way your contributions remain eligible for release under the first home super saver scheme. Mistake number 4. Getting the timing wrong when signing your home contract. The timing for accessing your first home Super Saver Scheme funds is precise and can be a bit tricky. Imagine you are on the brink of buying your dream first home and you're looking to use your super savings for the purchase. Here's what you need to know about the timing. There are 4 key points in the timeline. Request a determination, receive a determination, request a release, receive a release. Request a determination. This is where you ask the ATO how much you are eligible to withdraw from your savings under the scheme. You'll do this through MyGov, selecting which contributions you want to release. The ATO will then review your request, calculate your deemed earnings, and send you a summary. Number 2, receive a determination. You will get a notification from the ATO detailing how much you can release. This is what the letter looks like. Number 3, request a release. Once you have your determination, you log back into MyGov and confirm to the ATO that you are ready to receive these funds. Number 4, receive a release. After processing, which typically takes 15 to 20 business days, the money lands in your bank account. But where does signing your property contract fit into all this? This is a crucial part. You must sign your contract after you receive the first home Super Saver determination. If you sign the contract between receiving the determination and requesting the release, you need to request the release of your funds within 14 days of signing the contract. If it's more than 14 days, you will face a first home Super Saver tax penalty. You can sign your contract after you make a valid request to release your first home Super Saver amounts. You must sign a contract within 12 months. Remember, while you can request a determination more than once, you can only request a release once. And importantly, once you sign your property contract, you can request a new determination. Mistake number 5. Incorrectly declaring tax on the first home Super Saver release amount for the wrong financial year. This is a crucial point to note, especially if you're planning to release this amount around the end of the financial year. It's quite possible you might request a release in one financial year, but actually receive the funds in the next. So, which year should you declare the release amount for tax purposes? This is where it gets interesting. It's the year you requested the release that matters for tax purpose, not the year when you receive the funds. The ATO website gives a clear example. If you request the release of first home Super Saver amounts on 30th of June 2023, include the amount in your 22 and 23 tax return, even though you won't receive the release amount until July 2023. Yes, you heard it right, this timing is key, and it's contrary to what many might expect. Did you know there are changes to the First Home Super Saver Scheme effective from 20th of September 2024? These changes aim to introduce a much-needed flexibility to the scheme's current stringent processes and timelines. This means that a timing mistake, like signing a contract at the wrong moment, something we discussed in mistake number 4, might not be as detrimental after the 20th of September 2024. Curious about those changes and how they might offer some more leeway? Dive into the specifics by watching this video.